You know, in the world of corporate finance, there's this one number that holds a surprising amount of power. I'm talking about net worth. But we're not just going to cover some simple textbook definition today. Oh no, we are diving deep into the specific legal formula that can literally change the entire rulebook for a company almost overnight. So let's get right in.
So what is this single number? This one figure that can act like a tripwire, completely altering how a company has to report its finances forever? Well, it's called net worth. But as you're about to see, the way it's calculated is anything but simple.
And look, this isn't just some boring accounting exercise. The real power of this number, it comes directly from the law. We're talking about India's Companies Act. Think of it as a legal trigger with some pretty major regulatory consequences.
So what is it exactly? Well, first, I want you to forget that simple assets minus liabilities formula you probably learned in school. The Companies Act has a very, very precise definition. It's a formula that's designed to cut through all the noise, to strip away any paper profits and find the real core value of a company from a shareholder's point of view.
Okay, let's pull back the curtain on the formula itself. Now, the easiest way to think about it is in two simple parts. You've got a list of things you add together and a list of things you subtract. Let's break it down.
First up, the stuff we add. We start with the absolute foundation, paid up share capital. That's the actual cash shareholders have invested. Then we add the securities premium. That's any extra amount they paid above a share's face value. And finally, and this is key, we add all the reserves that were created from real actual profits. Just think of it like the company's savings account. All the winnings it's stored in the vault over time.
All right, now for the subtractions. First, we have to take out any accumulated losses, basically the opposite of those winnings we just talked about. We also subtract things like deferred expenditure. Now, what's that? It's basically costs that are paid up front, but their financial impact is spread out over time. The key thing here is that all these items reduce the real tangible value of the company's equity, so they have to come out of the equation.
Okay, we've covered what to add and what to subtract, but here comes the most important part. This is the step that trips up so many people. It's the list of items you must always exclude from the calculation.
Now, take a good look at this list. What do all these things have in common? Well, they represent paper gains, not actual cash in the bank. A revaluation reserve, for example, just means you've decided an asset is worth more on your books, but no money has actually changed hands. And the law is super clear on this, because these aren't realized profits, you have to ignore them completely. For our calculation, it's like they don't even exist.
All right, enough with the theory. The best way to really get this is to see it in action. So let's take a real-world example and apply all these rules we've just learned.
So, let's meet our subject. We'll call it Company A. And we've got its audited balance sheet from a very specific and very important date, the 31st of March, 2014. Now, this wasn't just any random date. It was a critical cutoff for a huge accounting change in India.
Okay, so here's the snapshot of Company A's finances. On the left, liabilities and equity. On the right, the assets. And you can see all the pieces we just talked about, right? There's the share capital, the securities premium, the reserves, and hey, look at that, there's a revaluation reserve hiding in there. And over on the asset side, we've got that miscellaneous expenditure. This is our raw data. Let's get to work.
All right, it's time for the moment of truth. Let's take these numbers and run them through our formula, step by step, to find Company A's official net worth.
Okay, first we gather up all the positives. That's the 160 from equity capital, 200 from securities premium, 150 from the general reserve, and the 75 from the P&L account. Add them all up, and that gives us 585 crores. Now we do the subtraction. We take out that 80 crores of miscellaneous expenditure, and that brings us to our final value.
Now hang on a second. I know what you're thinking. What about that 40 crores of revaluation reserve we saw? Well, this is exactly where that do not touch list becomes so important. According to the rule in Section 257, we completely, totally ignore it. It plays zero part in this calculation.
And there it is. The final official net worth of Company A as of that specific date is 505 crore rupees. And this single number is about to answer our big question.
And this is where it all clicks into place. See, for implementing the new accounting standards, which are called Ind AS, there was a threshold of 500 crores. Since Company A's net worth is 505 crores, it crossed that line. That means it gets swept into Phase 1 of the mandatory rollout.
So what's the bottom line here? It's simple. Because of that calculation, Company A was legally forced to adopt a whole new, really complex set of accounting standards starting from April 1, 2016. Just think about that, a massive operational change triggered by just 5 crores over the limit.
Okay, quick follow-up question here. The original case mentioned that Company A was listed on the stock exchange. Does that actually matter? I mean, what if it were a private, unlisted company? Would the outcome be any different?
The answer is nope. As you can see here, for this specific 500 crore threshold, it didn't matter. It applied to both listed and unlisted companies. The only thing that mattered was that net worth calculation. So listed or not, Company A was definitely in Phase 1.
So let's wrap this up with the absolute key takeaways. First, this calculation is always done using the company's standalone audited financial statements. Second, for this whole Ind AS transition, that March 31st, 2014 date was everything. That was the moment in time that mattered. And finally, and I find this part fascinating, once a company crosses that line and Ind AS applies, it is a permanent change. There's no going back, even if their net worth drops later.
So there you have it. You now know the official formula, and way more importantly, you've seen how one single number can have massive, real-world consequences for a company. But it does leave us with one last thought. We've seen what happens when it's positive. But what are the consequences when a company's net worth actually goes negative? Well, that's a whole other story. Thanks for tuning in.